So the first mistake is you're told to let your winners run and cut your losses quickly. That's an old adage, because if you let your winners run, does it ever go lower? Well, this is how the market is. It's up, down, all around. And when do you, if you follow this, like when do you get off and when do you get back in? So purposely, it's complicating. And it's easier when someone says, just let your winners run and just cut your losses quickly. Well, it doesn't work that way. Last year, Roku was up 322%. I mean, that line is pretty straight that I drew, but that chart, it's a pretty up and down chart. I mean, where do you buy and where do you sell? Shopify, another top performer, 193%. Same thing here. At the top there, and it dips down, where do you cut your losses at? It's hard to know. I mean, it's buy and hold, or so that's a mistake that a lot of people fall into, is that they fall into like just cut your losses quickly, but then if they do, then it goes in the other direction. It's a bugaboo. It's a trick. It's a mind game that happens. Same thing with Trade Desk, up 134%. That's a lot of volatility here. Sure, it was up 134%, but when you look at this, if you're a normal, ordinary investor, which we all are, some of us a lot more beginning, what do we do here? Well, one thing that we could look at that not a lot of people know about is every move, there's an expected move. And this is where the options market goes hand in hand with equities being stocks. The equities market provides an outlook on the expected move. So this right here, it's a lot of information, right? Typically, you don't want a slide with all this information, but this is an option chain. This is the SPY. This is from Friday's close, but you see all those options there. This is why people stay away from options. That's a lot of options, right? Got weekly, 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 but let's ignore that right now. Let's just talk about this on this chart, on this side here. On Thinkorswim, this is what I'm looking at, this platform here. It's an online brokerage. These numbers here indicate the expected move or the expected range. That's what expected move is. The expected range the market expects the SPY to move. If we look at the options that expire 10 days, so 4 down. 10 days, February 16th, 2020, the expected move for the next 10 days in the SPY is $5.80, higher or lower. That's what that means. So we use the options market to help us understand what we can expect in the equity market. If that goes lower, if it goes $5.80 lower, well, we know that. We don't cut our losses. Why? Because that's what the market priced in. So it gives you a framework to start to build off of and understand what expectations you have going into a position. If you just open up, if you bought SPY today, like what does a new investor do? You buy the SPY, which is the Spider S&P 500. Well, in the next 10 days, you can expect that price fluctuation is going to be higher or lower, $5.80. Now, if we go all the way down to the bottom here, we have a 44-point expected move up and down, and that's all the way into December of this year, the end of December, 210 days, 214. So we have an expected range where we can look at probabilities. This is all probability based. Options are based on probabilities. The market is based on probabilities. When you say just cut your losses and that's your winner's ride, it doesn't work because everything's probability based. And we understand the expected ranges that we can see, we can start to feel better about what we're doing and if we're doing it the wrong way. So here's another platform as well, and it's the same thing. Not all platforms have this, but most platforms are offering this. And this is just taking the option chain, and I call it almost under market. It's just, no one's going to open up typically the option chain, but this is where you can get all this information. It unlocks a whole new level of understanding the financial markets. It is a lot more complicated. It is a lot more in depth, but when you're putting money to work, putting risk out, you need to know what to expect and have a better understanding. And the options market, which trades actively, provides that information because they're all traded, bought and sold, that create these probabilities and these expected moves. So one thing I always talk about, we've heard the old adage, buy and hold, but it's buy, manage, and hold. If we buy and we manage our expectations, manage what we are looking to do, we take profits and we hold. Holding means managing what I expect to happen and be able to feel comfortable about what tomorrow is going to bring.